The information provided in this program is of a general nature and is not intended to be personalised financial advice. We encourage you to seek appropriate advice from a qualified professional to suit your individual circumstances. The Fed keeps hiking rates despite problems in the US banking system. Has it managed to balance price stability and financial stability? And Briscoes boss Rod Duke shares how his company is making record profits while other retailers are being forced to lay off staff. It's Friday, the 24th of March, and you're watching Markets with Madison. US Federal Reserve Chair Jerome Powell had one of his toughest days in the job this week, deciding to keep hiking interest rates to hose down inflation while the US banking system is kind of on fire.
Inflation remains too high, and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone.
The ninth consecutive hike was another 25 basis point jump, taking the federal funds rate to a range of 4.75 to 5%. It's part of a years-long campaign to rein in inflation caused by the pandemic and government economic stimulus. Interest rates are now the highest they've been in the US since 2007. The market was expecting this 25 basis point move, although some economists thought the Fed might do nothing following the collapse of 3 American banks this month. Jerome Powell called them serious difficulties, but the Fed has already stepped in to provide funding where needed.
Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again.
So did the Fed get the balance right between price stability and financial stability? Mark Riggle from Milford Asset Management is the macro man to ask. Mark, was this the right call?
I think the Fed did a great job of meeting the market's expectations and not creating more volatility, right? Which is exactly what the Fed wants to do. So they hiked by 25 basis points. That's what the market had expected. They didn't make any unforeseen changes to any of their other programs. They didn't change their quantitative tightening program, for example. He expressed confidence in the banking system. He did everything he could to make sure that the market wasn't going to be surprised by anything he said.
How tough of a decision do you think that this was for the Fed, given the US banking sector backdrop?
Yeah, I think it was in some ways it was easy because he knew what the market wanted and had to deliver that. But in other ways, a lot's changed in the last 2 weeks. In fact, it's changed so quickly that the economic projections that the Fed provide are now out of date because they were produced 2 weeks ago. And so that's a problem because the Fed don't know really what the impact of all the stuff that's happened in the banking crisis in the last 2 weeks is going to have on the economy going forward. So that's the bit that everyone was keen to know about, and he didn't really have too many answers on it.
The Dow slid 500 points on the day, even though this move was pretty much entirely priced in. So what do you think the market did not like about this move?
Well, I think there's 2 bits there. The first bit is, we know for the last 6-9 months, the share market in particular has been focused on this Goldilocks. And it's just been trying to sniff out, how much has the Fed got to hike? Is it going to be 50 bips next time? Is it going to be 25, 75? Always looking forward. And if it was worse than the market expected, it'd be bad. And if it was kind of maybe not so, a much hike as the market expected, it'd be good. We've now shifted on, right? It's now very clear that there is a potential risk that we're going to get economic weakness ahead of us. And that's what's going to deliver us rate cuts. That's what the bond market is telling us. And so that reaction of, rates are not going to go up as much, therefore that's good for the share market, that's now kind of gone out the window. Because if the bond market is telling you that Fed are cutting rates, it's because there's a recession. A recession is not good. I think part of it was that realization. The second bit wasn't actually what Powell said, it was what Yellen said. She was speaking at the same time, and she said that they weren't considering insurance for all deposits in the US. And so that hit banking shares and I think helped the market lower.
Alternative scenarios were for the Fed to go with either a 50 basis point increase or to possibly do nothing. Some economists thought that they might finally pause. Why do you think the Fed avoided both of those options? And hypothetically speaking, if they did go with any of those, how could the market have reacted to that?
So I think in either of those situations, it would have been, even though they were the opposite ends of the spectrum, the market reaction would have been quite negative in terms of the share market. If they'd have done nothing, investors would have been questioning, what do they know that we don't? Why have, given that everything that we've seen in the last 3 months has been accelerating inflation, accelerating economic growth, huge resilience in the economy, they need to hike more. So why are they pausing? That's a real issue. If they hike by 50 and just completely ignored the transmission effects of all the credit issues in the banking sector in the US, the market will be very quickly going, this is a huge policy mistake. We're now hiking into what could be a recession in the next 6 to 12 months. And so both of those tail scenarios, even though they're the opposite end of the spectrum, and that's why you had to walk the line, right? If it had delivered either of those kind of scenarios, I think the market would have been off significantly.
Jay Powell in his press conference suggested that the Fed could be at or very close to its peak rate increases. He said that just some additional rate hikes are needed from here. But he's also still saying that inflation is far too high. So which is it? And has he given up the fight?
I think if you listen to the first, statement that he gives, and when he comes to the podium, he always gives a little, 3-5 minute statement. And that's what he wants you to hear. He wants to get that out before anyone has a chance to ask any questions. And in that statement this time around, he talked about the need to focus on inflation still. He talked about the resilience of the labour market in particular. And that is the cause for them to have to continue hiking interest rates. But he also acknowledged that the outlook for the economy, the committee all agree, the risks are skewed to the downside. And so this makes it really tricky because the economic growth comes first, inflation comes second. If there's weaker economic growth, it's going to be really difficult for inflation to keep accelerating. And we're only going to see economic growth weaker after the fact. As in when the data tells us that we've seen weaker activity, it's going to be 1 month at least by the time we receive that information. So the Fed are going to be behind the curve. It means there's lots of uncertainty going forward because we know there's potential weakness coming. The Fed are trying to deliver it, but we don't know when it's coming. And so that's why the Fed are trying to feel their way along and taking the information as it comes.
Would you take his job if it was going? I don't think I would.
No, I don't think I would. To be fair, I think he did a fantastic job this morning. He was very measured. He had a lot of questions on a lot of different topics. He fielded them all very, very well. I think he's getting better at his job. But yeah, he can have it.
He only earns $190,000 and I say only because I don't think that's worth it for the pressure of the job, is it?
Exactly. He should be getting paid more.
Thanks so much for your time, Mark. Nice to chat to you.
Thanks very much.
Coming back home now, retailers always report later in the earnings season, so this week was all theirs. The Warehouse Group's profitability nosedived in the 6 months to the end of January, falling 60% to $17.3 million. The owner of the Red Sheds confirmed it's making 340 staff redundant, with the restructuring set to cost about $6 million. It won't pay an interim dividend. Compare that with KMD Brands, owner of Kathmandu and Rip Curl. Its bottom line surged 352% to $13.9 million, turning around a previous half-year loss. The retailer had record sales for the period and saw a small lift in gross margin. And Briscoes Group made a record full-year net profit of $88.4 million. To share his retail secrets with us, I'm joined by Briscoes Managing Director Rod Duke. Hey Rod, how are you?
I'm fantastic, thanks Madison.
That is fabulous. Record profit for the full year. How'd you do it?
I guess by just doing the regular things that we do, just watching the market, promoting the way in which we generally do it. It seemed to us nothing particularly special. We just had to try a little harder.
How do you feel about the economy in New Zealand right now?
Look, we've already said that we think this year we've just started. It won't be quite as easy as it was in the prior year or the year prior to that. But look, it's it is what it is. We're just all going to have to try a little harder.
Have you started to see any impact of a slowdown in consumer spending at all?
We've actually had a pretty good February and a pretty good March. So not just yet, but look, like you, we're hearing that the market's not the same for everyone.
What do you mean when you say it's not the same for everyone, Rod?
Well, I've got a lot of friends in a number of industries, and some industries are doing quite well, and some industries are finding it a bit difficult. So it's not the same everywhere.
Sticking with the retail sector, with the retail industry more broadly, you said that your result wasn't particularly special, but it sort of was when you compare it to other retailers that aren't doing so well, namely companies like the Warehouse Group, who are having to restructure and actually rid of some roles at the moment. Why do you think it is that other retailers could be struggling when the likes of your company haven't actually seen consumer demand drop off yet?
Look, I guess it's the offer and the proposition, and perhaps the way in which we put our stores and our promotions together. You know, we sell merchandise that is somewhat different from some of those people that you've mentioned. You know, we have for many, many years been philosophically in the high quality at a real good price segment, which is perhaps a little different segment than others are in.
You mentioned promotions there. How do you think about discounting? What's your strategy? When and why do you decide to do it, and when and why do you perhaps plan to hold off?
Look, we have to promote fairly regularly because most of our stores are not in shopping malls and in high-profile shopping regions, and so we're generally classed as a destination. So I need to give my customers or people who choose to shop with me very special reasons to buy from me, and that's generally high quality product at real good prices.
How do you think about inventory these days? Because I know that your company did shore up a lot of stock before COVID. You read that situation sort of earlier than most, but are you getting rid of it now? Are you selling any of it at a discount?
Our inventories currently are around about 10% less than what they were last year, and we're aiming to take another 10% out of those inventories. So, we think it's not going to be as buoyant, and so we don't need as much inventory this year as we did last year.
What do you think is the sort of ideal cash position to hold with inventory?
For us, probably around $65 to $70 million.
You've got a bit more of that at the moment, don't you?
Yeah, we've got about 77, 78. So there's probably another 6 or 8 weeks inventory there that we can work away at.
Now, I wanted to ask you as well, Briscoe doesn't actually have any term debt, according to your most recent report. Do you think that's unusual?
During buoyant times, an analyst will tell you that we have a very, very lazy balance sheet. In times that are tough, where interest rates are high, they'll tell you that we're a genius. So, look, it depends. You know, right now we're very, very clever. 12 months ago, we had a lazy balance sheet.
Which one of those do you think that you are, Rod?
We are very, very, I am very, very conservative in terms of borrowing money from banks. I have always preferred to lend money to banks rather than borrow money from banks.
I take it you're not worried about the current high interest rate environment then?
No, look, you've seen our numbers. I think at the end of January, we had $150 million in the bank and no debt.
You certainly did. Hey, thanks so much for your time, Rod. Lovely to chat to you as always.
Pleasure. Thanks, Madison.
Let me know what you think of our listed retailers and if you think the Fed made the right call this week. Now go put your money to work.
Thanks for checking out our YouTube channel. To stay up to date with all the latest news from the New Zealand Herald, click the subscribe button below or check out one of the videos here and head over to nzherald.co.nz for more details on these stories and more.